Hey, welcome back. Following the Alibaba and JD videos, I decided to make one for Tencent as well, a company that's also in my portfolio. Again, these videos come as an update thanks to China's recent shift in policy that has the potential to be the catalyst we needed to see Chinese companies rebound. This is a very diversified holding company that owns an ecosystem of global services from healthcare, social media, chatting, financial services, gaming, and much more. In certain aspects, this is very similar to Amazon, although I don't think they have the synergies that Amazon generates with Prime. Prime is Amazon's all-encompassing subscription model, while Tencent usually has individual subscriptions for each service. This one feels like they saw opportunities and bought into that market without necessarily having a plan to make them work together. Still, it can happen in the future, and this is important because with Prime, Amazon basically uses already well-established products to develop the new ones that they buy, basically making any acquisition likely successful. So when Amazon bought into healthcare or video streaming and included them into Prime packages where you get other things that you already use, they instantly gained market share and even became market leaders. The growth has overall been very strong, with a 14% compound annual growth rate over the past half a decade. We see the revenue coming from fintech and business services, games, social networks, and advertising, overall being very diversified. At such a size, with this being one of the biggest Chinese companies and in fact one of the biggest companies on the planet, this is comparable to Amazon and the rest. The revenue basically doubled from 2018 to 2023 and 10x'd since 2013. This is definitely impressive since they maintained a similar EBITDA growth rate on a nearly 40% margin and 70% cash flow conversion rate. They can make around 25 billion today, placing them at a ratio of 20, which is among the higher end for a Chinese company in this environment. If they were American and had these numbers, this could have easily been double. Still, with China's shift in policy, this has potential to attract more investors and by default increase Tencent's valuation. Keep in mind that being the largest Chinese company by market cap means they are a key position in pretty much any Chinese index fund or ETF. We see how big American funds own 1-2% of them compared to 7-8-9% for Apple and the rest. So if big money and retail investors go into the market, they likely even indirectly buy a lot of Tencent. Financially, we see a good position, with the current assets almost covering all the liabilities. There is about 134 billion in equity on a roughly 500 billion market cap, everything converted in USD by the way. That's generally not good, but this is a very digital company, so there is a lot of stuff that they can't really include on the balance sheet, meaning that there are significantly more assets. Don't worry, this is completely normal and in fact much better than American tech companies like Meta, Apple or Alphabet. This company, I'd say, has an overall pretty wide global exposure, which is a reason why they tend to be more expensive. With Riot and Epic Games, for example, they don't rely only on China, and a lot of what they have can expand into other countries. Gaming is actually one of the company's top revenue providers, and they have some pretty big plans in that from what I know. This is a giant company that has the capital to develop even more in SEA, India, Africa, South America if they want. Still, they will definitely benefit from an increase in interest for Chinese companies, so that's an opportunity no matter what. They also pay a small dividend, but they ramped up the buybacks to around a 2.5-3% yield lately. It's not as big as Alibaba's, that's among the highest on the planet, but it's at least something to move the demand a bit. That's the thing with the valuation, they're at a relatively high price for a Chinese company based on what they can make, so they can pay a significant dividend or buybacks. Now, another way, and actually the way I prefer to get exposure to Tencent, is through Prosus or Naspers. It's basically the same company. This is a South African company that, after selling some of its stake, owns about 24% of Tencent. Plus, they are a leader in e-commerce, payment solutions, delivery, and so on in many countries. What's interesting about them is that the stake is worth about 120 billion today, but the company's market cap is around 100 or even less after it has pretty much doubled since around 2022. So not only do you get Tencent at a discount, but the rest of the company, and these are huge players in the regions they operate in, is free. In my country at least, we don't really have Amazon because there is Prosus with their emac that's dominating the market. Competing with them would be tough even for Amazon. And they also do massive buybacks, being one of the best tech companies on the planet when it comes to repurchases. Apple, Amazon or Alibaba are far from this company's level. The problem is that this is an estimated value if they were able to sell everything at the current price. There is no world in which selling 24% of a company over less than half a decade wouldn't destroy the price. Look at what SoftBank did to Alibaba. They coincidentally had 24% of the company as well. You generate so much selling pressure that by default you have to assume a discount if you want to sell it. But they don't have to sell it. It's not the best, but they get dividends from Tencent and use them to develop the company itself. But this is a risk to remember when investing in Tencent. The moment they decide this isn't good enough and there are better things to keep that money in for them, this has potential to crash significantly. Even if they don't sell that much at once, the market may get the sentiment that they might sell more in the future and make it another Alibaba. Anyway, more about Alibaba in this video, by the way. Now let's see a valuation. In a bad scenario, let's say they drop back to 15 billion per year due to competition and an overall unfriendly environment. Say the market is trading them at 12 times that amount in line with other Chinese tech companies, and that's a market cap of 180 billion. That's a price of 19.7, meaning more than a 50% loss, getting them to the price from a decade ago. Sure, then they would be cheap and offer a potential opportunity, so it depends on how you look at it. In a second scenario, let's say they keep developing at only 10% per year, and I say only because it's very low for them, meaning something around 40 billion in half a decade. For a ratio of 25 to signal an improvement in demand for Chinese companies, that's a market cap of 1 trillion, meaning a price of around 110 for pretty much a 2x. That wouldn't be terrible, especially since the price is up like 50% in 2024, so it's double that much if you bought back then. In a good scenario, let's say they keep growing by doing acquisitions and developing in other countries. If they grow at 12.5% per year, that's 45 billion in half a decade. For a ratio of 30 to show both a higher interest for Chinese companies and more confidence in Tencent, that's a market cap of 1.35 trillion. So a price of 147.7 for almost a 3x, especially with higher dividends and buybacks. And keep in mind that the growth and price to cash flow ratio were relatively low for them, so it can definitely do better. So comparing them to Alibaba and the rest, we see that this one isn't that cheap. It's a good company and definitely a giant that can develop the same way Amazon does, by using the higher valuation to buy companies with a stock. Still, a recovery in demand for Chinese companies would by default lead to higher valuations for Tencent and potential for a decent profit. I bought Tencent through Prosus in 2021 and 22, but now I wouldn't really call them a buy. Again, others are significantly cheaper. If you watch my videos about Alibaba, Pinduoduo or JD, you can see that there is definitely a difference between them. Still, a very good company overall that has potential to improve, especially if they copy Amazon. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching, and I'll see you next time.